Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming from Ticket Talker. Let's jump right into the board here, and we have kind of a mixed opening here in precious metals. Stocks continue to rally here at 41.72 for the mini S&P. Gold at 1782.40. It's up about 630, while silver is down to about 26.40, 650. Copper is slightly lower at 450.51. And GBTC, Grayscale Bitcoin Investment Trust, is up about 112. Coin is down 139. And we have kind of a mixed picture for the time being. We have a bullish trend momentum unfolding here in the gold market. So I want to jump right into the market and let's take a look. On gold here, trading on the average of 1763, which is the average, 1783, which is the average for the day. Trading above this average, it activates a bullish price trend momentum. The AI, the artificial intelligence of the VCPMI, which is written in C++ in easy language in TradeStation, when the market gets to this level here, it's neutral. The average price is a 50-50 standard deviation, and so it could go either way. And what you see here is the frame for today's day trading structure, which is a composition of 5 levels, a perfect Fibonacci structure. And within those 5 levels, it identifies the pivot points. The algorithm, the probability model, the filter ignites these pivot points by identifying the extreme level above the mean or below the mean on a mathematical basis. The probability model identifies the areas in blue to be at about 50-90% relative to the implied volatility to the mean. The by 2 is a 50-95% relative probability factor to the mean. The vortex composition of the mathematics identifies the extremes above the mean at a 50-90% relative implied volatility from this cell 1 level. The cell 2 level is a 50-95% probability factor. Now, this may look very simplistic in its nature, but it has built in a tremendous amount of intelligence. And what I'm doing here is I'm reverse engineering the process for the benefit of you self-directed traders that want to learn something different, maybe, that you've been used to and it's not working. What I do here is called mean reversion trading. And it doesn't take into consideration the fundamentals of the market in any way, shape, or form. It is a probability model. It's a mathematical model that is a combination of Fibonacci, WD Gann, Elliott wave principles, vortex mathematics, directional movements, averages, all into a filter that is called the variable changing price momentum indicator. Now, within this filter that you see here, the algorithm identifies that if the price is trading above the average, what it identifies is the price trend momentum. When the price trend momentum is identified, as it is in this case, it automatically activates the target above, the level above of 1796 as your next target level. Now, we don't trade around the average. Personally, I choose to trade the highest probability trades. You as a trader, obviously, you can trade any bar, as most traders do, but there is a methodology that I have learned, a discipline that I have learned from the VCPMI that has tremendously improved my results. From just a standard deviation, to what now we're looking at is signals that have 95% probability factors, which are mathematically the optimal levels for you to execute a trade. This doesn't mean that it's a guarantee that, 90% guarantee from cell one or 95. No, these are the mathematical probabilities that upon the market confirmation, if activated, and it follows the procedure, it follows the methodology, it would be a high probability that the price could revert back to the mean. You see, the function of what we're doing here is basically the supply and demand exchange that takes place in a particular trading session. In this case, we're looking at a day trading session. But the methodology can be applied to a weekly trading session or a monthly trading session or a yearly trading session or a cyclical trading pattern. The variable changing price momentum indicator is a momentum indicator where it prospectively gives you the mathematical calculations for you as a self-directed individual to apply it pretty much like a GPS for your trading. When you want to go driving day trading, you turn on your GPS, turn on the day trading structure that you see here, and you let the market confirm or validate your entry points. So right now, for example, we're neutral. There is no trades. There is, neutral. We're in a neutral position, but for day trading purposes. What I do is I take the same methodology, the structure, and apply it to my weekly trading, to my monthly trading, to my long-term trading position. Given the structure in the data, obviously, is going to change, but the methodology, the formula, the algorithm is the same. The difference is that it extrapolates, obviously, this targets within the time frames that you're looking at. So for me, it's a question of how do I take this intelligence and apply it to all of the trends. I want to see all of the trends, whether they're short-term, intermediate, long-term, or cyclical trends. Because I think the most optimal relationship that I have found with extreme accuracy is when we are able to identify what I call those harmonic relationships, where the price on all of the trends, they come to par, so to speak, at a same level, so to speak, or at a par level or zero, where the price is the same on all of the trends. And only the market will choose, to move at random towards these levels. And for most traders, including myself, before I begin to be very mechanical, robotic in my trading, it is very confusing if you don't integrate the data, and so the markets are a matrix, a mathematical matrix. And within that matrix, the speculation of the market tends to drive the prices to extremes above or below. And what I have discovered over the years and testing this is that the markets will always revert back to find that equilibrium. And that is a universal law called the reversion to the mean. So what I do is I trade the mean reversion, meaning, when the price gravitates or it trades at extremes above or extremes below. Very quiet day today. Gold up 620, 1780, 220. It's trading here on the average, and I use this Thinkorswim chart not only to teach you self-directed individuals, if you want to follow on a simulated basis, or if you want to trade, that is up to you. I use this simulated platform because I use it for myself, actually, where I incorporate all of the pivot points for all of the different time frames, and I have a pretty clear picture where the market is in relation to all of those targets. So what you see here is that the market traded the weekly average 1771 after it made a high of 1799. It came down, activating the weekly trigger points, almost a monthly, not quite. The 1809, 1800, 1806 was the top of this extreme above the mean level. And I pointed out in my videos, if you take a look at my videos here, the last few days this week so far, that the VCPMI identifies this area up here as a distribution area of supply. When the algorithm identifies that the area is a distribution area of supply, what it means is that you can expect sellers to come into the market. You can expect supply to come into the market. And the algorithm, the code, tells you target completed from the average below, short trigger activated at 7:15 a.m. on the 4th, and automatically the targets below, which is the mean, the initial targets, and then the extremes below the mean targets were completed. In this case, the 1771 weekly average price of 1771. It tested these levels twice, the weekly average, and activated bullish price trend momentums. And so now you see why we recommend do not trade around the average prices. Because it's choppy if you want to day trade. Or even if you look at the weekly or monthly, if you're in that range where you get the harmonic relationship around the averages, you're going to see the market chop around. Now, this bar here at 8 a.m. yesterday, you know, why it occurred, it's irrelevant to the algorithm. The fact is that the algorithm activated a short trigger at 7:15 a.m. and whatever caused this sell-off here, it's irrelevant. The fact is that it, you know, unfolded in the momentum or the direction of the market, the momentum of the market. When you take a look at the internet and you read all these pundits that talk about the silver market, it's saturated with negative propaganda, negative commentaries that are irrelevant to your trading these markets, as you can see here. And this is what I'm trying to point out to my traders in my Discord private trading room, that the less chatter, the less noise you hear or you allow to influence you, the more money you're going to make by using the VCPMI. The VCPMI is a prospective algorithm that it's irrelevant of the fundamentals that get them there. In the same way, obviously, on this red bar, that what was the reason for the market going up here to this sell one level? Now, they blame the banks, the central banks, the manipulation, and on one hand, and the short squeeze on the other. And the market is saturated with this rhetoric. And you don't see the market exploding, right? It's been down since August high of 2089. So the point that I'm trying to make here, ladies and gentlemen, is that the market in gold and silver is a market that will go whenever it is ready to go, regardless of the fundamentals. And what we have seen here is an anomaly, a separation of the fundamental market with the real market, with the paper market, as they call it in the futures markets and derivative markets. It is a product of the market doing what it has to do in order to complete its technical patterns, and it will go when it's ready to go. So if you're trading Reddit, if you're trading all this pundits, short squeeze, rhetoric, I think, it's already factored into the market. It's not affecting the market. All this movements to short squeeze the silver market. Let's buy it all together at the same time. I believe that they haven't been around this markets long enough to understand the dynamics and the components and the logistics of what makes the market work. Meaning, the sentiment right now is extremely bullish. It's been the bullish, I think, the most bullish sentiment in my career. And what I've learned about the markets is that the markets don't go when everybody wants them to. So now I give credit for the Reddit crowd, so to speak, Wall Street silver crowd, for putting the market in a limelight that the whole world now is aware of. Silver is aware of gold. It's aware of what's going on. And that's an accomplishment, a big accomplishment. But when you take a look at what happened back in February, for example, the Reddit move did catch the world by surprise, caught this short position by surprise. Nobody was expecting this movement to unfold, where you consolidate a large number of small retail accounts that can make an impact. But the impact was short-lived because the market moved ahead of itself, and we saw silver reach $30, 30 and some change. $30.35, and that was it. This was the Reddit movement and the short squeeze movement. And what we saw here is the market drop from 30.35 all the way down to 23.74. That's almost a $7 an ounce move against the sentiment. So this is basically the confirmation that I need to have as a trader, that the markets move on their own, particularly in the silver market, particularly in the gold market, highly technical markets. In, I think, the whole economy, the whole market pretty much became virtual back in March of last year. When you take a look, obviously, at the mini back then, you can see what I'm talking about here. And, we traded 21.74 on March 23rd. And we're at 42.11. Wow. What an amazing move. On the face of a pandemic. So what you see here is we went into a virtual economy, a virtual world, and the stock market knew what was going to happen. The market always knows ahead of time that we were going to move into the Zoom world and the digital world and the digital currency world, and pretty much moving into a virtual economy. The gold market made a law of 1167, on March 16, made a low of about 1450, and we saw a high of 2089. Now, the gold market discounted the bad news while the stock market continued to make new highs. And I think what we're looking at in terms of the gold market was this was a pretty substantial rally of more than $600 an ounce. And if we analyze the market from the bottom in March, this leg, again, was the first leg. If you use wave counts, not necessarily Elliott wave, but use wave counts, wave patterns, this was the first wave, the first leg. And now the market went to see and discount what the real damage is going to be. But this rally here was on the basis of the Feds opening up the printing presses and announcing that they are going to print as much money as needed, unlimited amounts, and I believe, in fact, looked at about 10% of GDP to allocate for the pandemic, for the crisis of the pandemic. That's a $30 trillion allocation. It's never been done in the history of the world, in the history of this country. So now, the market knew this, it rallied, and it waited to see the results, the casualties. And we came down here to a critical level that incorporates the long-term correction in the market. If we take a look here for a minute and we do a Fibonacci retracement here, what you're going to see is the market coming down right into what it's called a golden ratio Fibonacci retracement. On the face of one of the most bullish aspects or fundamentals in the market. The gold market collapsed. The silver market collapsed down to a 61.8% Fibonacci retracement, which was in that 1694 area, approximately, and reverted. Now, as you see here, the correction came right into this blue level that is identifying the codes monthly, weekly, and we saw a reversion occur on March the 8th, this March, from that level. And so this is the pattern that we are following right now. The market has activated this leg up, which in a way looks like a little bit of an ascending wedge, pointing to about the 1850 target. So you know, to just review what I'm saying here is, and I'm talking kind of two different languages between the fundamental market and the technical market. And what I'm really kind of trying to point out to you, that for myself, when I'm trading, when I come into the room, when I turn on my GPS, I close my blinders, so to speak, to the fundamentals, and I trade what the market is giving me, what the market is telling me. And I begin to see, you know, the relationship of the codes to other indicators, to which are technical classical indicators used. And I began to get a sense more of a validation, confirmation, or negating the analysis or the algorithm. Once again, I think the more disciplined that you are in executing the algorithm, the more effective it's going to be in the bottom line. We're looking at the daily algorithms on the left. The monthly average price was 1758. And the market on April 29 came right into this average price, almost into that weekly buy one level of 1752 and the buy two level of 1752, which is a perfect harmonic alignment. The low is 1754.60. So buyers came in at a higher level. Came up the monthly average. It engaged the monthly average into a monthly bullish price momentum, and the target was completed right away. It activated a buy trigger from buy one. On the 29th at 7:45 a.m. And this signal here, for example, activated a buy signal, and automatically the target above was also activated. And in this case, the target was completed at about 11:30 a.m. This signal came in at 7:30, at 7:65, and it completed the target in that 1771 area, you know. So this is, and we have completed these trades. We have done these trades. Our traders in my Discord trading room get all this intelligence posted almost 23 hours a day whenever there is a signal. And I use this trading room to execute my own trades, my own account, to teach and coach, as I'm doing here, for the benefit of those serious traders that come here every day and learn what I believe is an exceptional trading tool. It's a probability model. So coming back to the algorithm here, now we're neutral here. Traded around the average, we're neutral, 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 neutral. Activates another buy signal here. This is a trend alert. The structure of the algorithm basically is from a neutral zone. The algorithm identifies an active signal. When it touches the first time, it's neutral but active, and it's telling you prepare. If it closes above, using the 15-minute bar, which is the time frame that we use to execute the VCPMI, if it closes above, you buy long. You go long. If you buy long, automatically you put your stop below. And we give you three choices of stops: a dollar stop, maximum catastrophe stop of your profile, based on your profile. The most conservative one is the close below. If it closes below, you can get out at the market. And the third one is basically you wait till the close of the day. If you're day trading, you got to get out at the end of the day. You got to be disciplined. It is up to you as a self-directed trader to apply this intelligence correctly, methodically, with discipline. The more you adhere to the signals, the more success you're going to have on your driving when you're trading. A signal was activated here. The target automatically was 1771. Completed. On 4/29 at 11:15 a.m. So here's another signal at 8:30 a.m. from 65.70 to 77. That's a phenomenal day trade. We go neutral. We're on the average. We go back to neutral and we wait. Didn't quite come down to that B1 level daily. So we're neutral. We're neutral until you see this and it activates automatically a buy signal by connecting it to the price pivot point level and closing above it. Now, if you're an aggressive trader and you understand and you're more advanced in terms of the application of the VCPMI, and pretty much we teach you that at the academy, is you can begin to customize this to your profile. Once you understand how to ride the horse, you can ride it as fast as you want to, or you can gallop it, right? I mean, once you learn how to use the GPS as a driving tool, then when you go on the driveway or you decide to trade, then you can drive as fast or trade as much as you want to. If you're trading multiples, you can measure the multiples according to your profile. And here's a trade. I'm just giving you the direction of the market. And I think maybe I want to save the application in multiples here for another session, because it is important to understand how to manage your multiples when you're executing the VCPMI. The VCPMI is a directional movement. It's a directional indicator. And it is up to you as a self-directed individual to take that intelligence and apply it to your profile, depending upon the risk that you want to take, the instrument that you want to trade, the sector that you want to trade. Personally, I have identified the sector to be the precious metals. The choices that I have is gold and silver. And within that sector, you have tremendous derivatives underneath. You have hundreds of derivatives underneath, thousands of derivatives that you can use to execute this information exponentially beyond your day trading objectives. If you're a serious trader and you're using this tool to manage your overall portfolio, if you're a full-time trader, if you're a home office, or an individual, accredited trader, this is an incredible tool for you to be empowered and make the decisions yourself. And we've had a tremendous success, and not only in trading this application, but teaching, coaching it. Now, we just came back from a tremendous crisis here. Back in March, I admit that I did lose some money, some positions, just never had a chance to come back. And unfortunately, the timing sometimes can be crucial when you're trading. And so it's a question of how you manage it, that will allow you to stay in the game. And I was able to recalibrate according to the volatility and everything else, and take advantage of a crisis situation that provided an opportunity, a historic opportunity, man. I mean, if you would have bought gold at 1450 and you're sitting on it at 1782, that's still a phenomenal return. Or if you bought assets at that time, derivatives, and you're holding long-term, you're doing quite well. What is uncertain is the short-term aspect of the market, and that's why I use the indicator, the VCPMI, to guide me, to identify for me the short-term gyrations of the market. So here, we recommend basically, again, you buy, coming back here, you buy the buy one and you sell the mean. Came down here, you buy the buy one and you sell the mean. You don't need to trade when it gets to the mean, but you can use it as a target. And you can just see it here, back and forth, all the way from the end of April, coming down here to 1763 on April 30th. Now, when the market comes down into the area of blue is what I call, which is really the buy one level and the buy two level. You're entering what the AI identifies it as accumulation of supply. This is where you accumulate inventory. Above the red is distribution of the supply. So when it comes down to that buy one level, you accumulate supply, inventory. You want to trade it, you trade it against the targets above. Here, again, we're neutral and we're waiting for the market to activate either the extremes above or the extremes below the mean. It activated a bullish price trend momentum on the 3rd. Automatically, the target above, weekly of 1788, was activated, as well as the 1796 target was activated. Target completed, 1796. From the third at 1785, at 5:15 a.m., the target was completed at 7 a.m. 1796.10, and they went back and made a new high of 98.90. Now, when you saw the price get up here in red, automatically it's telling you, you got to be careful up here. The probabilities are inverting. You got only a 10 to 5% probability for buying up here. If you're on sell one, it's a 10% probability, as opposed to a 90% probability that if we activate a short trigger by closing below, the market probably is going to revert back. To the mean, which is at the 1782 level. And you see the reversion unfolding. The distribution of supply is taking place. Supply is coming into the market. And it comes down almost to complete the average price until finally target completed on the 4th with a low of 1780.80. What do? You go neutral again, and you wait until the next signal is activated. And in this case, when you met the average price, obviously you were neutral again. And you allow the market to release the reversion to the mean, or the principle of mean reversion trading. And that is that the market will revert back to the targets above, up to possibly the extreme above. And what we saw here was a new high of 1799.50 on the 4th at 7 a.m. Target completed. You took profits again. It never closed below this level, so it never activated a bearish price trend momentum, but it did activate now a short trigger from the daily sell one. The signal was activated at 7:15 a.m. at 793.80. Your stop, again, was automatically above, and you got three choices of a stop. And we saw the market collapse, whatever the reason was, this red bar, and brought it into the targets that we are right now. We're testing the weekly average. Tested it at a low of 1769. Went back again and turned on the bullish price trend momentum. And what does it do? It activates the targets above. Completed. You go neutral again. You wait. And this is what it's called the VCPMI, or the variable changing price momentum indicator. Another signal at 5:30 a.m. this morning. Between the averages, so we're neutral, waiting for the extremes to unfold, either for the market to run up to 1788, meet the target of 1796, daily and possibly go up to the 1806 level. This signal activated a weekly bullish price momentum with the first target of 1788 to 1796. Trading now above the daily average is activating 1796 and 1809. We actually completed the silver targets and the gold targets. If you take a look at the highs that we made today was 1784.90. The target in gold was 1782.40, which was the mean, and the target in silver was 1766.5, and the high that was made so far is 26.71. And these targets were announced pretty much last night. Yesterday, actually, at 9:10 a.m. And these targets now have been completed. This was the earlier pattern, and so now let's take a look. What's going on here? If you have been following my videos, I announced that pretty much I have a core position that I'm keeping long until about 1810. I will take a look at it at about 1810 once again. But we are maintaining a long-term core position, and we are using this VCPMI indicator to identify the overbought conditions in the market, the extreme levels above the mean in the market, to be able to trade, to place some short-term trades. So if you're a day trader, obviously this gives you the ability for you to trade more actively by identifying the extreme levels above or below the mean. If you're a swing trader, you can position your core position or your swing trades accordingly by using the weekly signals, and also taking advantage of the targets daily when they're completed. And depending upon the multiples that you have, you can execute the multiples upon the targets by increasing or reducing your inventory. My position right now is, as I'm synthetically long. I'm again recommending long positions. My core position is long, and once again I'm using the rallies here into that 1810 to lock in profits and possibly prepare for some kind of a reversion from those levels here. So I hope that once again, when you come here every day, my friends, that you are picking up something that will make the difference in your bottom line. That's my hope. And I thank you for the time that you've given me to share this information with you. Until next time, my friends, you be well, you take care, and I'll talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.